Interested in real estate? How about wealth? Well, they go hand in hand. And here, you'll learn all about it. Welcome to Be the Bank, a podcast where we discuss and debate the topics centered around real estate investing. Your host, Justin Bogard, shares insights into investing in real estate to create real wealth and passive income for you and your family. He'll share stories of real estate investments done right, walk you through the process of owning a real estate note, and most importantly, educate you so you can be the bank. This is Be the Bank, brought to you by American Note Buyers. Now, here's your host, Justin Bogard.
Hey, welcome back, listener. This is Justin Bogard here on the Be the Bank podcast, season number 6. This is the first episode in 2024 for season 6. Today, I have a guest, my friend, Mr. Chris Seveney, founder of 7E Investments, and we're going to be talking about kind of commercial loans. It's kind of a subject matter that Richard and I really hadn't got a chance to talk a whole lot about this year. Chris going to bring some valuable insight to this, and we're just going to be discussing kind of what's going on there and what opportunities are you going to see, and just have a little fun little conversations. So stay tuned. Happy New Year, my friend.
Happy New Year. How are you today?
I'm doing pretty well. It's been kind of cloudy here in Indianapolis, and so last few days have been just kind of like depressing. I hate to start off the podcast that way, but I'm just going to be honest. It's just been kind of gloomy and yucky out.
We've gotten cold. It hasn't been too gloomy, we're over here in the Northern Virginia area, but getting colder. It's a nice balmy 42 here today, but
Yeah. I tell you what, I live like on the 3rd floor, and so I have a lot of windows. And so when the sun comes out, when on the cooler days, like these 30-degree days and stuff, it's like I don't even have to turn on my heat because everything resonates from the bottom up. So it's kind of nice. I actually kind of like enjoy the winter because I don't have to pay as much electricity. So
yeah, I joke when, my team who's out in Southern California, joke about being 70 degrees there. I'm like 72 in my house every day. So, hey, I'm at 72 every day. We built our house, we spray foam insulated it. So when we did it, so it's pretty tight. And thankfully we, don't have a 100-year-old house that basically lets all the heat out, where our electric bills are not too bad.
I love the character of old like colonial houses and stuff built in like the late 1800s, early 1900s. But man, I don't want to live there anymore because I agree with you. It's so inefficient. So inefficient.
Yeah, when I was up in Massachusetts, I'll share this one story before we get going. Same thing. I love historic homes.
Yeah.
We were looking at a house that was built in, I think it was like 1789. This was early 2000s. This house was awesome. 8 fireplaces. I mean, one of them was just humongous. I couldn't buy it though because I was getting sick because the floors were so unlevel that like I was like almost like in I don't know, it just screwed with my perception of things.
Okay.
The house was just so awesome and I loved it, but I'm like, I couldn't live in this thing because like I feel like I'm like walking up and down hills because the foundation, it's of course settled over time, old fieldstone foundations and wide pine floors and everything. But it was an awesome house. But yeah, so it's the oldest house that I've ever considered.
I've never seen a house that had an established built date back that far. So Indianapolis has a lot of late 1800s, early 1900s homes, and then a lot of 1950 style, craftsman style homes that are just all over the blue collar parts of Indianapolis. So.
Mm-hmm.
But anyways, man, we're not here to talk about our stuff. We're here to bring up kind of, being the bank, talking about loans, specifically commercial real estate loans. So over the past year, I've noticed, you've probably noticed more, that a lot of people were talking about, hey, watch out because things are changing in this climate as far as a lot of these office buildings that have mortgages on them, strip malls and things like that people got loans on early or pre-COVID. Those are being called due because for the listener, as you may not know, when a commercial loan gets created, you don't necessarily have like a 30-year mortgage with 30 years worth of payments. You usually have a balloon with an amortization of 20 or 30 years on it. And that balloon, Chris, correct me if I'm wrong, can be anywhere from usually like commonly probably like 3 to 8 years.
Yep. Typically, so short term, anywhere. Some will even go a year, which, back in the day wasn't too much of an issue, but typically the ones you'll see are between 3 and 7 and 8 years.
And so now, if they're being called due, they are in a bad environment to refinance that loan because interest rates have obviously gone up. I would say probably 2.5%, 3% pretty easily since they got those loans originally.
Yeah. Yep. And that's part of challenge. And when people look at that commercial side, which we'll dive into deeper, is that interest rate risk that they play off of, because your cap rate, which is how the loans are, I'll say it's a valuation method. It's not the end all be all.
Yeah.
But the way they're valued is based off of cap rates. And what's happened is, the cap rate previously was, let's say, 5%.
Mm-hmm.
And, your borrowing rate was at 3%. So to borrow money at 3% to gain 5% is, arbitraging where it works. Today, interest rates might be, at the, 6-7%, but the cap rates are also at that or slightly, even if they are lower. So to borrow money is actually hurting you, because it's like, think of taking a home equity line of credit. If I took a home equity line of credit out at 7%, to invest in a treasury at 5%, would you do that? Of course you wouldn't.
Right. This makes sense. I owe you 2%. What? I don't like that deal. Yeah, no one likes that deal. So that's the quandary that they're in. And I've heard more that the office, like the downtown office space type of loans, are ones that are getting hit the hardest. Have you heard the same thing, or are you seeing something different?
So during the break, there was a statistic or a chart that just came out I saw on LinkedIn.
Okay.
That the number of distressed multifamily loans is now greater than office.
Okay.
So both situations in reality are not in a good place. And part of that also is it's not only the loans that are in default, but the loans that, let's say I had a multifamily building or an office building, doesn't matter.
Okay.
That, let's say I had a floating rate that was coming due.
Okay.
And you have a loan that, hey, you were smart. You got the fixed rate, 5 years, whatever the case may be. So what's happened to, I'm basically in trouble. I'm probably going to lose my property. So I'm going to get foreclosed on, which is going to sell at a discount. Now, your building that's 4 blocks away, just like appraisals happen, so forth, what's going to happen to your building? Just even though you're still doing well and, so forth, your building's going to be devalued as well.
Yeah, it's coming down.
Yep. And that's what's happening is, even to the ones that are doing well, you got to remember a lot of these are in syndications.
Yeah.
That, one investor went and raised a bunch of money from people and it's like, hey, I'm going to sell this thing in 5 years and my loan is for 7. So it gives me some play. But that 5 years is coming up and guess what? They can't sell because their cap rate, even though they're okay on that debt service to pay the loan, that cap rate is increased. So now they're going to take a significant hit. And on average, every 1% is about 15% of value of a property, roughly, to give you a ballpark idea.
Wow. That's a big hit.
Yeah.
So I'm not sure when a lot of this is going to come to fruition. I'm guessing it's going to be more like a longer waterfall from starting probably last year and probably go out another 2 or 3 years that we're probably going to see, depending on if the rates actually come down a lot, which I don't think they will. So I can see this being opportunity for people that have funds that are ready to pounce on those opportunities to turn those real estate commercial buildings or what have you, or multifamilies, large multifamily buildings into some good opportunity where they can get some good buys. Because I can see some of those owners just handing back the keys to the bank and be like, it's not even, I can't even try, I can't even try to sell it.
Yeah. And the reality is anyone that knows when it's going to happen or how long, they don't. The reality is there's so many, impacts that affect, the housing, the interest rates and everything else. Everyone can assume, everyone can guess. Everyone's like, oh, there's an election year, so this is going to happen versus that's going to happen. Nobody knows. I mean, you've had, a pandemic. We've had, wars going on that have impacted things. So I think people can read the tea leaves on things. And even people reading the tea leaves, some think everything's going to be hunky-dory fine. Others are like, not so much. You can be in either camp. But the reality is, nobody knows. But you can just look at data and say, hey, there's this percent of commercial debt that is coming due, and this much is underwater. So, what's going to happen with that debt is really and those properties is going to be the $1 million question.
Yeah, I like how you brought that up, because and I agree exactly with what you're saying. It's so hard to really have a good prediction as to what's going on far out. It's more or less, like you said, you guys got to understand the data and see what the trend is, and make sure that you make a direction change if you need to as quick as you can. Because so many people have been wrong that have been experts that I respect and look out to, but they're really just guessing off of past experience. And unfortunately, past experience, this is new territory for everybody. I don't think there's been a cycle like this the last 5 or 6 years, because of things like you said. We had a pandemic that was just, nobody was expecting that, obviously. And then you had a couple of wars and supply chain issues because of all that, just a trickle down effect, and had a super bullish market in real estate for so long since the Great Recession. We kind of knew there was going to be a correction, but we didn't know how a correction was going to happen or when. But it's kind of like it kind of started correcting. I feel like the market has started to correct as far as real estate.
It has, and you mentioned interest rates as part of that. I think the Fed, they forecast out where they anticipate, the Fed rate to be. I think next year they expect it to be at like 4.5 or 4.75. Which I think today is between 5.25 and 5.5.
Yeah, I'm not sure where it's at, but
yeah,
that sounds about right.
Yeah, and people are like, well, technically the Fed rate doesn't impact mortgage rates, but it kind of does, and it doesn't. The last time, and again, you can go back in 2005. I think the Fed rate was at like 4.75, and where were interest rates? They're about a point to a point and a half higher, which is typically where they are. But again, they're based on 10-year Treasury, and we're not going to go down that deep dive.
Yeah.
But I think the people who are sitting there like, oh, I think interest rates are going to go back down to like 2.5 or 3. Well, if they do, just realize that the economy is in a world of hurt if it gets down to that level. The Feds are not going, they're trying to control inflation. And part of that is, the cost of goods and cost of services. So they're trying to increase unemployment back up to 4.5% or wherever it is. And then, trying to decrease that cost of goods. They're not, if the economy is doing well, they're not going to drop it back down to 2% or again, because we're just going to take off again. They're trying to control it. And so if it does shoot down to like 2.5%, just realize that everything else is probably also, you're probably in a deflationary period. And again, I'm guessing, but based off of common sense in that point of view, the only reason they're going to go really low is if it's starting to be a hard landing.
Yeah, I can't imagine an environment anytime soon that it would get down that low. But then again, who are we to try to predict what's happening? Because there's just too many unknowns that happen in the future that are we just don't know about. But yeah, when these commercial loans, like this is something that I don't know if your fund is preparing for these opportunities with non-performing commercials, but we're trying to prepare for it, and we're trying to come up with strategies and ways to think like, okay, when we get these opportunities in front of us that we can get these non-performing loans, or maybe they just become REOs pretty quickly, and we can buy these things for a really good discount. What are we going to turn these into? What are we going to do with it after that?
Great question. And it really is going to be dependent, I think, on the asset itself. For example, office. I come from commercial background, and converting a office building into residential is usually not economically viable.
Yeah.
And I'll explain quickly why. Office building is usually a square box.
Yeah.
And you got to get light into, those areas. To have a bedroom, it needs to have a window. Well, unless you're making it a donut and cutting a hole down the middle, then you have to realize that an office building does not have the adequate water and sewer supply as a residential, does not have enough power for a residential. It doesn't make sense. Now, a few things that people can do is try and, whether it's office or residential, try and rework it or upgrade it. But, some other options besides just buying that defaulted debt is if you can get out early enough on it, can you provide rescue funding? So let's say I need $1 million that I'm short to do a loan extension or a modification where the bank says, hey, we'll modify this or refinance it, but you got to come up with $2 million or $1 million. Well, let's say I need $2 million. If I go to you, Justin, say, I really need $2 million. Well, you kind of have the upper hand on that and say, okay, if the value of the property is 10, I'll give you 2 million, but I want 30% of the equity.
Yeah. So, an equity play. Yeah. I was thinking you were going to get there. Yeah.
Yeah. So that's another option that you can have in regards to some of these assets. And, when people look at real estate is very cyclical, and people who, if you can hold for the longer period, long haul, you typically win. So let's say you do buy an office building that, okay, I have a 10-year horizon. So eventually I suspect, this will come back in 10 years. Unless it's out in the boondocks and just like really random, but what I've seen people do is turn that into self-storage, as well. So things you can do, but over a period of time, more than likely, it's going to be a wave where, you might be underwater for a period of time, but hopefully you can come back up and ride that wave as time moves on.
Yeah. When you brought up the architectural part of taking real estate, commercial real estate, and converting it from like an office space to residential, there was an article I read, I think I posted about this online, where there was a big New York landlord that is doing that and wants to turn his building into luxury apartments because they can see a lot of these, autonomous vehicles being able to pull up, kind of like, I picture this at Disney World where the train runs through the hotel. Like I can picture these short-term taxi rides that are coming up, through the resident building for these people just to be able to travel wherever they want and not actually have to go outside. So I can see that sort of thing happening. But yeah, you're right. It's like if you don't figure out how to use the space that's in the middle of the building, very well, it's going to be very difficult for all the plumbing and HVAC and
elevators. We need more elevators, and I've done it. I did a project actually. The last one I did was a project in Alexandria, Virginia called the Orinoco that we turned into high-end condos. And this building was C-shaped. We still had a lot of demo involved in the project, but it was suitable, somewhat suitable. We actually in this building had to take where the concrete slab, and we had to raise every floor by 6 inches to meet handicap accessibility.
Wow.
So we basically had to build it up on 2x6s across, and let's see, was it 60 condo units, averaging about 2,000 square feet. So, it was a major renovation and a lot of work to do.
Yeah.
But we've looked at others, like especially in downtown DC, and it just, the numbers, typically they just don't work. Fortunately.
Yeah. So when you did that stuff, were you based out of DC?
Yeah.
Like in the Washington DC area?
Yeah, I was working for a local real estate developer that was doing it, and they got very creative because everyone else was looking at this ugly office building that literally was on the water. There was a park in between that and the Potomac River. So where it made sense is you could get a premium for those units where, the top unit sold for about $1,800 a square foot. To give you an idea for, what the units sold for, they sold for anywhere from $1,000 to $1,800 a square foot. And this was back in 2014. So, which at the time, I think the high in the market in the city was close to like 900. So they were really pushing the envelope on doing it, and the only way they made the numbers work is because they could get such a premium price for those units.
Is the DC area pretty pricey in lease or rent payments for commercial stuff compared to other major cities in the U.S.?
Oh, it's there's what's called K Street, which is where all the attorneys and law firms are.
Yeah,
DC is astronomical on housing and on office. Housing rentals are, last time I checked, it was a little over, I think, $5 a square foot for an apartment. So if you have 1,000 square foot apartment, paying about $5,000.
Wow.
I want to say office space, depending on location, is anywhere from like 40 to 90 a square foot.
Oh, wow.
Yeah, it's because again, look who's in DC. You have the
Yeah.
federal government, all the lobbyists.
Yeah.
So everybody wants to be as close as possible.
Yeah, no, that makes sense. It just when you were talking about that, I was like, yeah, I think because you had mentioned that to me before how expensive it was, and I've never lived there, so I never knew. I think
Mhm.
Richard spent some time there, so he had told me it was expensive too. But yeah, I have no, I live in good old, the crossroads of Indiana here, so that it's a lot different market.
It's
There's not a lot of companies that want to be out here.
Yeah, it's different, but it's also again, it's going to be expensive. And the other component to it, where it's going to cost you, is how many companies are experienced in how to do it. Perfect example is up in Boston, for example. Most buildings are built with steel construction.
Okay.
Down in DC, most buildings are concrete. If
Okay.
I want to build a building in DC and I want to build it out of steel, in Boston it's cheaper because everyone does steel. In DC it's more expensive because everyone does concrete. You have less competition. So when you think about, oh, I want to go do this, well, I got to hire a contractor. If they know there's not a lot of competition, I'm the only one who can go do this type of work, then of course they're going to charge a premium also to do that work, especially if they're busy.
Switching gears slightly.
Yep.
So I read a couple articles recently that I didn't pay attention to until I started reading some headlines more and more, and it was about bank jobs that have been cut in 2023. I think it was something over 60,000 jobs with the major banks that they have cut jobs. So do you think that's a telltale sign of the banks are having some issues with their profitability?
Yes. So I would look at banks, and people realize too, banks, especially on the commercial side, banks are a primary lender, but even on the
Yep.
residential, there's a lot of other non-bank traditional lenders and how much they're cutting staff and actually going out of business or closing shop. So you're seeing a significant decrease in jobs in the mortgage industry because who's getting loans? And then, like you said, people look at the residential side of things and say, oh, not a lot of homes or transactions. That's happening on commercial and multifamily as well.
Yeah.
There's that bid ask spread of the seller needs this much and the buyer only wants to give this much is the same, especially in this interest rate environment. So it's a tug of war where there's not a lot of transactions happening. Well,
Yeah.
think about how many people are tied to a transaction. You have the bank, how many people at the bank, at that lender or bank, the title company, and so forth and so on. There's a lot of people involved, and you're seeing those aspects or those areas cutting a lot of jobs.
In that same article that I read, and I think I read this a few days ago, I thought I read there was over 250,000 tech jobs lost in 2023 as well.
Yeah.
Did you know that?
Yeah, the tech industry, I have a family member who's in tech, and actually they were in the mortgage tech, and the company they were with literally just shut down because they were doing a lot of the lines of credit that were like no appraisal. They do kind of like that online.
Yeah.
Those companies, basically are just dead in the water today. But, people look at, okay, Facebook, Amazon, Tesla, Google, like the big 3 or 5.
Mhm.
I think somebody mentioned to me like the big 3 or 5 tech companies are the only ones that made money last year.
Wow.
Everyone else in tech. And I follow a woman online who raises money for venture capital, which is all in the tech space.
Mhm.
And there was a statistic. I don't remember the numbers, but the number of tech failures last year and the number of companies that have just shuttered is like in the thousands because of not being able to raise money and just the interest rates. So the tech is also really taking a beating.
Do you correlate some of that with the fact that so many tech companies started up during the COVID time period? To
Uh,
where maybe we had an inflation and a big influx of tech companies, and now we've kind of reduced the fat a little bit of non-essential ones?
I think so. I think there's two key pieces to that. One is yes, during the COVID, but also you got to remember the government printed, I don't even know how many trillions of dollars at very low interest rates.
Yeah.
So a lot of companies were like, hey, I have this money now. I'm going to go invest it in all these startups in all these areas. Now you're seeing those companies being a lot more selective in where they're investing.
Yeah.
3, 4 years ago, VC had money flowing in like there was no tomorrow. Now you look at it and they've completely dried up. And a good example is that I'll use is like, look at those NFTs, those non-fungible tokens. I mean, those basically people were starting companies or writing those things and they were selling for thousands or tens of thousands of dollars for just a piece of digital art that really had no value. Now what's happened to them? They're like baseball cards. They're basically worthless. And
Yeah.
so, I'll use that as a similar
It's
scenario.
funny you mentioned baseball cards. My dad and I happened to look at some of our full set of Topps baseball cards from like the mid 80s and stuff, and we were reminiscing about it, and we were just toying around and looking at the values and stuff. And you're right, the values aren't anything astronomical like you would think, with 30 to 40-year-old baseball cards. It's just kind of funny how you brought that up compared to NFTs. But so what is going on with Seveney Investments? I follow you. You're my friend.
Yep.
And I get to talk to you, at least once a month. We get to talk, if not more. And so I know that you have definitely grown a lot this year as far as the expansion of people that work with you guys, and growing your fund and all the the asset management part of what you do. So what has this 2023 been like for Seveney Investments?
So 2023, a lot of people will look back at 2023 and be like, oh man, what a hard year, difficult year. And, I thought the same thing. And then I started, I read the book Break the Gap in the Gain. Great book, by the way, where it really tells you to focus on everything you gained. And, we went from at the beginning of 2023 from a $5 million company to over a $20 million company at the end of the year. We have over 500 investors within our fund. So we are continuing to grow and raise money to invest in performing and non-performing defaulted paper, and we're looking at 2024 as another good year. And last year in the space there's a lot of pivots. Early on in the year, we were at a point where we were trying to buy loans early on, and it was difficult. And then towards the summer and the end of the year, all of a sudden it's like, wow, we've got all these loan deals coming in, and it's trying to raise money to fund those deals. So overall, I look at it as, being a successful year. Of course, there's other things you'd like to look and do better. Interestingly enough, I'll share this with you because I was doing a recording for some people in one of my membership groups about, setting a 1 year and 3 year goal.
Yeah.
And I was using the template from 2020, actually, and that I had put together for my own personal goals. And I had a 3 year goal of where I wanted to be at the end of 2023. And it was, having bought over 750 notes, which I think I'm there. I've doubled the amount of money that I've raised. But the big thing, or my big, hairy, audacious goal, was I wanted to leave my W-2 to work full-time and run my own company, which fortunately I was able to do that in 2022. So it was a year early. And it was interesting because I didn't even notice I forgot I had this actually. And I went back and pulled it out and kind of like dusted off. I'm like, wow, I actually like checked the box on some of these things. So that's awesome. That was very, I think made me feel very good. Back at that, that's the best way.
Well, you should. And a lot of people, I don't think they knew. The people that know you in the space, they might not have known that you still had a W-2 job because it seemed like you were so fully active in the real estate space. And I actually had forgotten that you still had a full-time job till you told me when you did finally quit the W-2 job. But it is impressive how much you're able to have system and processes and all these efficiencies to help you grow to where you are today. So congratulations. And that's awesome to see how you guys went from, it seemed like this year was a very powerful year for you, at least noticing it, at least from an online perspective. Perhaps it was always that way the whole time and I just didn't notice it, but definitely noticed it this year.
Yeah. And I think part of it is, within the space, a lot of people come and go, and a lot of people will chase the shiny objects. For us, I'm a big Top Gun, movie buff, never leave your wingman type. And, that's how I look at in your investment strategy is, you just got to harness and focus on that strategy. Because I've seen people who've gone out there and, they went from one to chase the short-term rentals. They've chased all these other asset classes, and it's okay to diversify. But when you do a huge shift from one to the other, it's a big uplifting and understanding what it's going to take. Most people underestimate that. And that's where I've seen a lot of people fail, is because they underestimated that and they left what they're good at,
Yeah.
And for us, we just want to I'd rather be the best at one or two things than be average at five things.
I fully agree with what you said, and I've seen it too with people coming and going pretty quickly. And you hit the nail on the head, in my opinion, as well. Is that they don't realize how much work it is. It's not passive to run a business. It's not supposed to be passive, right? Unless you are having people run it for you. But when you're the owner operator, it's not passive. It is active, and it's hard work, just like anything else.
Yeah, and the other thing I'll just mention to that is, having looking ahead and being able to, one of the things that we do a lot of is, if this, then that type situations. Okay, if this happens, how does it impact our business, our market, our profile? And that's where, having been in real estate for a few years, for me, shows that experience comes into play, understanding that, when the government was printing all this money, I was wrong that I thought home prices would drop dramatically.
Yeah.
I was right that interest rates were going to shoot up. But now how did that have its impact on things? People are seeing it today where, for example, I know a note investing company that they have bank lines of credit, and they were originating commercial loans at 8% because their debt was at 5%, but their 5% was floating. They were lending at a fixed rate.
Yeah.
Now that their floating debt is now at 11 and they're getting 8%, they're like, uh-oh, now what do we do? And they can't sell the loans, or they'll sell them at a loss. So they've got their hands tied. So for people, no matter what you invest in, play out every single scenario in your head, even if it doesn't happen, if it could happen, play it out. And how are you prepared, or what are some of the steps? And you don't need the full-blown plan, but if it happens, it's like, okay, here's what I would need to do, or here's how I need to be defensive with my business, because it can take a company down, and I've seen it happen. So you just need to be careful.
Yeah, you're right. It's scary, and thanks for mentioning all that. Dude, we are out of time for today. So thank you for being on the first episode of season 6 on the Be the Bank podcast. I'm Justin Bogard, my friend here, Chris Seveney, founder of 7E Investments. What's your website? Is it 7einvestments.com?
Yep. The number 7, the letter E, investments.com.
Cool. Check him out. Check out his fun. Check out, they do have a podcast, and they do have a group of people that they do webinars to. If you want to be part of that group, you can reach out to them, and I'm sure you can find all the information on your website.
Yep. Everything's on the website.
Cool. All right, brother. Well, it's good to see you. It's good talking with you. And I will see the rest of you guys on episode number 2. Don't forget to check out the video stream of this on our YouTube channel, the American Note Buyers YouTube channel. Until then, see you guys later. See you, Chris.
Thank you.
Thanks for listening to Be the Bank. We hope you learned something from today's show. If you enjoyed this episode, please rate and review us. Plus, check out our channel on YouTube and follow us on Facebook and Twitter at Be the Bank, and on Instagram at Be the Bank Podcast. Be the Bank is sponsored by American Note Buyers. Thanks again for listening.